Good morning. It's Thursday, the 14th of March, and this is Govindraj Ethiraj in transit but otherwise based in Mumbai, India's financial capital. Our top stories and themes for the day: the stock markets fall on overall shakiness as regulatory overhang continues. Overseas companies reduce stakes in local subsidiaries and investments. ITC parent BAT kicks off. Are the Securities and Exchange Board of India and the Reserve Bank of India too soon or too late in responding to the market froth? Morgan Stanley says it's a 2000s-like feeling with the stage set for a private investment boom. Gold and Bitcoin, how two totally divergent asset classes are zooming away. And luxury brands pile on to big leases in 2023 across India as demand rises.
This is a core report with Govindraj Ethiraj.
Markets plunge on weakness but may settle down for now. It's a market-heavy show today, so let me start off. We've been calling a weak market for a few days now, and it is indeed exhibiting all the signs of one that has no major upward triggers combined with continued flow of capital, which of course is getting absorbed. I will shortly explain why and the pulls and pushes at work right now. Before that, what happened on Wednesday? Well, the BSE Sensex fell 906 points or 1.2% to end at 72,762, while the Nifty 50 actually went below the 22,000 mark to end at 21,998. That's down 338 points or 1.5%. Now, these percentage points are important because if you look at the mid and small caps, the fall has been much steeper. So in contrast to the roughly 1.2 to 1.5% fall in the benchmark indices, the broader Nifty Midcap 150 index was down about 4.1%, and the Nifty Smallcap 250 index was down 5.2%, their biggest fall in 2 years. Also, they've been sliding in the last few days as well. Now, there are several sectoral indices that fell too, which is also reflecting their presence in the small cap or smaller cap indices, and thus vice versa. So what are the forces at work? First, the regulatory overhang is still strong because it is clear that both financial regulators are now investigating various sources of funds and the movement of them, particularly into the smaller cap and SME or small and medium enterprise stock universe, where listing guidelines are a little less stringent. One sign that the froth, to use Sebi's term, has been fueled by money that is either non-taxed or non-accounted emerged following raids by the Enforcement Directorate on a Dubai-based alleged money mover or hawala operator. Moreover, stockbrokers are now asking for additional margin money from clients in order to keep positions, but some clients are choosing to liquidate those positions instead due to the perceived risk, according to Money Control. There is another factor that's affecting some prices, though with an interesting twist, which I'll come to. Bloomberg has compiled a series of stake sales involving foreign companies reducing their ownership or stake in Indian companies, essentially taking advantage of the high prices, though that might also be combined with some strategic moves as well. At least 7 firms, including home appliance giant Whirlpool and Singapore Telecommunications, have reduced holdings in their local units since June, according to data compiled by Bloomberg. Whirlpool reduced its stake in its Indian unit from 75 to 51% last month and said it plans to use the proceeds of about $470 million to reduce debt. Singtel, that's Singapore Telecommunications, plans to use funds to invest in areas such as data centers, according to exchange filings, which means it's diversifying. British American Tobacco, or BAT, has been talking to bankers for a large divestment, which it has now kicked off. Interestingly, the last major exit was in 2022 by cement major Holcim AG when it sold its India business to the Adani Group in a deal worth about $11 billion. Of course, all of this is being cushioned by continued and strong inflows into mutual funds and markets in general of domestic money. Equity assets with local money managers rose to a record $277 billion in February, with flows to recurring stock investment plans or SIPs reaching a new monthly high of $2.4 billion, said Bloomberg. The twist is in ITC. Its key shareholder and once parent BAT had announced a month ago that it was officially reducing its stake in ITC. Now, I can't help but add that speculation that BAT would reduce stake in ITC is now several decades old, and it's finally happening now. ITC's parent is also not seen to be active on the company's India operations, at least not the way we've seen in companies like HUL or Nestle, though the brand and ownership patterns are quite different. The twist is that the ITC stock price shot up in a weak market on heavy selling. Moreover, brokerages are now putting buys. Its stock price was up about 8% in trade on Wednesday following that 3.5% stake sale by BAT, which was worth about 17,500 crore rupees and only at a small discount to the previous session's closing price. So this sale has taken BAT's holding from about 29% to 25%. BAT will have to wait for about 180 days before paring its stake further, according to Money Control. So, why did it shoot up? One view, according to Money Control, is that the stake sale could lead to a re-rating of ITC stock as investors view it as more independent. There is no perceived change in the fundamentals, though. So, the increase in liquidity of the stock is being seen as a plus. All this is interesting because in many other cases, the same factors would have sent the stock price in the other direction. One stock brokerage, Prabhudas Leeladhar, has said that their long-term target on ITC is now around 465 rupees to 480, implying an upside of about 18%, according to Money Control. Now, to come back to small caps and mid caps, it's not just existing small cap stocks and hundreds of them which are now hitting circuits, that is the lower circuits, and sinking, but also IPOs which for the first time in months are not getting gobbled up on launch, as we are seeing right now and have been seeing for some time. I reached out to G Chokkalingam, founder of Equinomics Research, and I began by asking him for a temperature check on the innards or the middles of the market and also on how he was seeing the outlook.
This is just busting up the bubble in micro cap, small cap, and to some extent in the mid caps also. It was expected because in 30 years I have never seen this kind of rally in small and micro cap across the board. Last 30 years it used to happen only in few sector, few themes. This is the first time I'm seeing across the board, across all the sector, all the themes, it happened. And second, the valuation multiples jumped as high as 50 to 100 for hundreds of small cap and micro cap stocks. That was also not seen in the last 30 years. So therefore, the fall was expected and 21 lakh crore got wiped out in last 3 days. Small cap index is down 13% from its peak in a matter of 35 days. But I still believe the small cap index can fall either 7% or another 17%. Roughly about 30% correction should happen. That would be healthy for the markets.
So I'll come back to the definition of a bubble in a moment. But when you look at small cap or mid cap stocks, now these also include some of the well-known companies. So how are investors buying then? Is there only the size of the stock or the value of the stock which is driving their investment? Because everything seems to be falling. Some relatively better known ones with the relatively unknown ones.
Yeah, this is very unfortunate truth about the stock market. When bubble burst out in a small and micro cap, unfortunately, they drive down the mid cap also. In fact, as we discussed last time, the margin funding was estimated to be around 54,000 crore a month back, record level of margin funding. So what happens? The stocks in which there is a bubble or elevated valuation, there are some companies, just to give an example, I saw 5 years, no revenue, zero revenue. And only the last 2 quarters, some revenues that again all clearing. But the market cap was more than 1,000 crore. So what I'm trying to tell you is that when the bubble burst out in such stocks, the inexperienced investors, new investors, they lose heavily in such stocks. And in fact, in many cases, they can't even get out because they get into lower circuit. And therefore, what happens when they are tied up in margin funding or losses are heavy on borrowed fund, they sell quality stock also because in such market, quality stocks fall 2 to 4, 5%, but the bubble stock fall 5 to 20%. So therefore, they take a rescue by selling quality stock. So that's why invariably both of them fall. But generally, quality stocks fall less than the kind of fall you see in the bubble stocks. And also the fact is that whenever recovery happens, the quality stock would recover very soon and they never fail you to create wealth also.
Right. And of course, what those quality stocks is a slightly different and longer discussion. So you're saying that therefore there is now a clear bubble in the middle of the market, and the top, which is the large cap stocks, seem to be, which is when we say large cap, we mostly mean BSE 30, BSE 100 or NSE 50. Those seem to be largely insulated. Is that correct?
Yeah, only small point. I have little reservation when you say that there seems to be a problem in the middle. Actually, the problem is slightly below middle. It is micro cap and small cap. Like, for example, very simple common sense approach I follow historically. If you take a Sensex, it touched 393 lakh crore. And today it is 372 lakh crore, 21 lakh crore washed out. Even today, if you see all market cap 372 lakh crore rupees, and then take BSE 500, that market cap, And if you subtract from the 372, the market cap of BSE 500, the gap is around 36 lakh crore. That is where the exact problem is. So the 500 has some middle also, but slightly below middle, what I call is a pure small and micro cap and SME. Even today, after such a crash, it is 36 lakh crore. And for your information, in 2020, that used to be about just 8 lakh crore. So the correction, I believe, is not yet fully done.
Right. And so if you were to look ahead, forgetting any other external shocks or any other external events and factors, how do you see this going? I mean, do you see this settling down? I'm talking now about the overall market. And will the overall market be affected by all the corrections that will be happening in the small and micro?
Overall market might fall 2-3%, but it will definitely bounce back in a big way because of three reasons. The GDP growth, all of us know, fastest to growth. And second, structural changes, happening in a certain sector, like a banking industry, like credit growth, quality of assets, and then mobile manufacturing, so many things. Third structural story is massive inflow of investor. Even now, 6 lakh investors are coming per week. So because of these structural changes and the solid growth story, the large cap will bounce back. It will bounce back once again because it has severely underperformed small cap in the last 3 years. Small cap index, in fact, it jumped 3 times the kind of jump in Sensex and Nifty. So for these reasons, market will, in terms of Sensex Nifty, will bounce back in a big way. There is nothing to worry, and India will again create a solid story, even the small and mid cap. It won't take very long period for the correction to continue because due to the technology and mobile digital information flow and the execution of the trades, all the punishment and reward would happen in a very, very shortest time period. So all this correction and pain, it will be done within 1 week or 2 weeks. But the damage will be big in small cap. So it won't take much longer.
Right. So I guess that's both worrying and comforting to know. Chokka, thank you so much for joining me.
Thank you.
The rupee is down while oil is up. Elsewhere, the Indian rupee dropped on Wednesday on the back of weakness in most Asian currencies after US inflation data topped expectations or was higher than expectations, but most market participants said the decline was likely a blip. The rupee was at about 82 rupees 86 paise to the dollar on Wednesday morning, according to Reuters. Meanwhile, oil was up on Wednesday. US crude oil and fuel inventories fell last week, Reuters reported, with sources citing American Petroleum Institute figures ahead of Wednesday's official US inventory report. Brent futures for May were up 83 cents or 1% to $82.75 a barrel, so basically below the $83 mark. Market regulators, too soon or too late? The Wall Street Journal had an interesting piece on the front page. It hailed technology stocks as secure against higher interest rates or oil prices while rapidly expanding. For all the talk of a high-tech bubble, there is basic logic driving the divergence of market values. High-tech is where the growth is, it said. Now, this article appeared this month, that's March for sure, but 24 years ago in 2000. A Wall Street Journal columnist points out that we know now that the dot-com bubble that had started to deflate 2 weeks before this piece was even published, and the Nasdaq dropped by almost 80% to its low 2 years later. Back home, that the stock markets have turned a little shaky, at least in the middle, in the light of increased regulatory scrutiny, is quite clear. It's also clear that much of the money that has flown into small cap and mid cap stocks, and I'm sure others as well, is not patient capital, so to speak. You can infer this from the fact that the source of the funds itself, whether unaccounted in tax or raised from borrowings on assets like gold, makes them either suspect or fundamentally volatile. If people have borrowed to put funds into the markets, it's logical that they will always be on the edge for fear of losing their principal and by extension their shirt, and would thus run for the door at the slightest hint. We have, of course, now been noting how the Sebi and Reserve Bank have been cracking down for some time. While market participants, including wide-eyed fintech bros, have been expressing extreme shock and displeasure and also have been suggesting, if not arguing, that the crackdowns were either unfair or an attack on budding entrepreneurs or an overkill, I would actually ask the opposite question. Did the Reserve Bank and Sebi wait for too long? The only reason I ask or pose this question is first, because someone should pose it, and second, because the quality of surveillance and monitoring, not just by the exchanges and banks, but the larger financial transaction system, is way superior to what it was even a few years ago. And what that means is that there is now highly sophisticated software that I am aware of, and I'm sure many others are, that is powering the triangulation of transactions at the income tax, for example, amongst other authorities. So you could safely say that the regulators have been seeing unusual activity for a while and from many angles. By the regulator's own admission, in some cases like the Paytm Payments Bank, they found KYC norms being violated for many, many months or maybe even a year. Elsewhere, the Sebi is also saying that they've been seeing unusual activity in small cap stocks and on the SME stocks in exchange for a while. And when they say a while, I obviously mean several months, if not a year. In another case of a bond issuance where Sebi cracked down on JM Financial, the case is likely from November 23, only 5 months or 5 long months, depending on how you look at it. Moreover, it clearly appears that there are elements of unaccounted cash flowing in as raids by the Enforcement Directorate are purporting to reveal, not in the bond case that we referred to, but elsewhere. So if all of this is the case, could the regulators then have acted sooner? Now, this is obviously rhetorical, and there is no easy answer because if a regulator acts too soon, then the move in itself could spook the markets prematurely. And the regulator could also be then on a back foot of sorts because actions like this tend to rock the whole boat, which obviously has other ramifications. Imagine the markets being in a 10 to 20% free fall. For instance, Kotak Bank founder and market veteran Uday Kotak said on Wednesday he acknowledged the presence of some frothiness and bubbliness but emphasized that it was not yet out of control. He said he saw a significant growth in the futures and options category, indicating the dynamism of the market but stopping short of suggesting an impending bubble. So, the term bubble itself denotes something different, which is the final outcome of everything that goes in. But some or a lot of the funds going in itself have doubtful provenance, as is now evident. And also, it does appear that there are bubbles within the market and not necessarily the whole market. Also, the term froth is now being freely used on Wall Street as well, as investors and market watchers debate whether the current levels, which are, as you know, all-time highs for the Nasdaq, the S&P 500, and the Dow Jones Industrial Average, are too high. Perhaps the answer is yes, no, or somewhere in the middle, as it always is. Whichever way, it's clear that the regulators relied on data and evidence to pronounce that there was froth in the system, which is, of course, a good thing. But conversely, it also suggests a delay and a potentially costly one at that. The right way to perhaps call it is to blend intuition, experience, and early data, which in any case we have more of, and thus call out excesses. On Wall Street, the focus seems to be more on whether it is a speculative mania or not, rather than misdemeanors, which is not to say that there aren't any misdemeanors, it's just that no one knows of them right now. So, finally, no one is saying that all of this is an easy task, but that is exactly what is expected of regulators, and surely of regulators who are better armed with technology, data, and intelligence than ever before. Foreign brokerages bet on India's investment revival and growth. While on the ground there are all kinds of selling pressures, foreign portfolio investors are obviously taking some effort to reassure all that the micro fundamentals of India remain solid and will get stronger. Economists at Morgan Stanley are saying that investment has become a major driver of India's booming economy, adding that the country's current expansion resembles that of the mid-2000s, when growth averaged more than 8%. The contrast with the 2000s is perhaps statistically appropriate. I don't know about the other things. Morgan Stanley economists say that the economy appears to have room for further expansion given that path for additional capital expenditure, especially from private businesses, rising exports, and a more stable economy, according to Bloomberg. After declining for more than a decade, India's investment as a percentage of GDP is steadily climbing and could reach 36% by 2027 from a recent low of 28% in 2021, the economists said. Now, that upswing mirrors the period from 2003 to 2007 when India's investment ratio was almost 40%. While this is very likely as capacity utilization in the private sector is now reaching its peak, it's yet to happen in a meaningful way. Earlier this week, economists at Societe Generale, who seemed a little more circumspect, wrote that investment remains a major growth driver for India's economy. They said that they were seeing early signs of a revival in private capital expenditure and signaling that investment appears to be expanding beyond just public capital expenditure, which is obviously all the investment that you see that the government is doing. Gold and Bitcoin walk hand in hand. Gold and Bitcoin are setting new record highs at the same time. Now, we've been documenting the gold part, but not so the Bitcoin part. The interesting thing, as you well know, is that gold is the ultimate safe haven asset, while Bitcoin is a highly risky and speculative play and is either heavily regulated or banned totally, depending on where you are, and not so with gold, of course. So what does it say about the markets when both these asset classes, almost at the opposite ends of the spectrum, rise in unison to record highs? I reached out to the Sydney-based Peter McGuire, the Australia's CEO of trading firm XM.com, and I began by asking him what was driving this unusual phenomenon and what his outlook was, particularly for gold.
When you're thinking about what Bitcoin's done in the last 14 months, nothing short of just shake your head in disbelief. It's just mind-blowing. And gold has had such a dramatic rally, really from those lows that we experienced in early October. In that window of time, you're up 20%. So I think there's many different reasons. That also you've got to look at central banks and buying of gold and of course the attraction from the retail public in the sense of having gold under the bed, under the pillow and everywhere else. And the attraction is very much global. So there's that side of it. And then, it's been turbocharged with, direct purchases, as we mentioned, from central banks, and China's certainly leading the charge. And you've got, I think, a degree of uncertainty with interest rates, policy, inflation, and that crept up overnight. You saw those US numbers, which isn't a good sign. And that would be, I think, add more fuel to the fire as far as when do we see blast off with a rate cut projection. And then all of those moving parts working through, I think there's been some people have looked for the opportunity. And this has been very much the part of the attraction, and the hordes have very much bought into it, and the price has demonstrated. You only got to see one thing, Govind, and that is price. And price has shown us, what we saw the other day, 2,200. So it's just been spectacular, right? As I said, there's many different viewpoints, but that just crystallizes and simplifies it.
And I'll come to gold in a moment, but what does this say about the way the markets or investors are buying? I'm also assuming it could be two different kinds of investors, because Bitcoin is on one end of the spectrum and gold is on another end of the spectrum as assets go. And yet both seem to be moving at this point almost in tandem.
Yes, yeah, absolutely. Well, I mean, you've got the paper market that's been introduced now to Bitcoin in the sense of ETFs and that style of investing. And of course, what you're doing with actual holding crypto itself. And we've got the situation presenting itself next month, halving in April. And that's the last time they did that. It happens every 4 years. So that was 4 years ago from the halving of Bitcoin. And that's, I think, going to add more fuel to the fire because there's only so many tokens. And I think that'll probably push price up. I'm hearing numbers quoted, 100 to 200,000 by end of year. So that's US dollars. So let's just see what happens. There seems to be a stampede on there at the moment. And that's just the situation. So how long it lasts for, Govind, I don't know. But maybe we're in bubble territory or we're not.
Yet all of this seems to reflect a certain, let's say, race to get onto assets which are either safer or going to appreciate more than whatever else is available. Would that be a fair assessment?
Well, I think so. I mean, you've got to be conscious that as far as the big picture from a property standpoint, you've got 20% of commercial properties. I saw a number. It's the biggest washout that we've ever seen in the US that are vacant. You've got the property market is absolutely capitulated in China. So there's that storyline. So when you're saying traditional asset classes, there's only so many places you can hold funds. That creates the geopolitical uncertainty as well. What's going on? And, we're worrying about, I suppose, the recessionary fears, and the overall, demand picture is very, very strong. And I think that's the nervousness in entering the market. And that's where people are, hedging their bets, so to speak, and buying gold.
What's the outlook like, at least as you're seeing it, given all these factors, both on the demand side, particularly in the demand side, both from, as you said, central banks, as well as people who want to keep some gold under their pillow. So you have both these sets of investors or buyers in the market right now. But what's the outlook?
Well, I think it's strong. You've got to say that I think the overall theme is going to be very strong, certainly for the rest of this year and well into 25, I would think, because the market, many analysts were saying, Govind, you will see probably in the second half of this year, you could touch 2,200. Well, we've got there in the first just over 2 months, and the momentum has been extraordinary over the last, 4 to 5 weeks. Very, very strong, probably up the best part of, 10%. It's up 20% since, as I mentioned, in October. So there's that side of it. And then the next side is, does this momentum keep on going moving forward? You know, the geopolitics, the inflation, the debt crises that you see, you know, you're ratcheting up the best part of $1 trillion of debt by the Fed every 90 or 100 days. Now, that's not a good sign. And there will be a judgment day one day, and it's an enormous amount of money. You've got the BRICS, the other side of it, of course. So, yes, maybe it's a shift away from the mighty dollar.
Peter, thank you so much for joining me.
You're more than welcome, Govind.
Luxury brands pile onto real estate. High streets have emerged as the top leasing choice for luxury brands in 2023, recording over 100% year-on-year growth, while malls remain the second most preferred luxury realty category with a 300% year-on-year growth, according to Sebi Richard Ellis data. Real estate leased by luxury companies in India stood at about 0.6 million square feet last year, which was 170% higher than 2022, according to this report on Wednesday, which attributed the trend to skyrocketing awareness about brands, presumably luxury brands, according to Business Standard. Established luxury brands are actively seeking expansion opportunities in metro cities and pursuing larger space take-ups in existing locations, the reporter said. Affluent consumers in Tier 2 cities travel to the nearest metro city for their luxury shopping, and this is prompting luxury brands to look beyond the top-tier metro cities and open stores in places like Chandigarh and Ahmedabad, the report said. Demand for premium and luxury goods is increasing in the country due to a growing middle and upper class, said the report released jointly by real estate consultancy CBRE, that's CB Richard Ellis South Asia, and the PhD Chamber of Commerce and Industry. The report was based on data from 8 cities, that's Delhi, NCR, Mumbai, Bangalore, Kolkata, Pune, Ahmedabad, Chennai, and Hyderabad. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.